Most investors right now are hiding in the same five overcrowded trades: energy stocks, consumer staples, utilities, the safety plays. And look, I get it. The last couple of years have been rough. People are scared. But here's the thing nobody's saying out loud. The biggest money in this market is made right before the crowd figures out what just changed. And something just changed. I've spent the last several weeks running through earnings reports, 13F filings, valuation models, and macro setups, and I found 10 stocks that I think are seriously mispriced right now. Some of them I own, some I'm actively watching. Every single one of them has a specific reason it could outperform over the next 3 to 18 months. This is not a clickbait list. These are real names, real theses, real numbers. Before we dive in, if you're new here and you're serious about building real wealth, not gambling, not chasing meme stocks, but actually building a portfolio that could change your financial future, hit that subscribe button right now. New videos drop every week and you do not want to miss what's coming. All right, let's get into it. Here's the macro picture in 30 seconds. Oil prices have started to pull back. And if that trend continues, and I think it will, the consumer gets stronger. Cyclicals wake up. And the stocks that got absolutely crushed over the last 18 months start to look very, very cheap. We're talking about 10 stocks today. I'll give you the bull case, the risk, and exactly what I'd do at current prices. Stay until the end because the last stock on this list might surprise you most. It surprised me. Okay, stock number 1. And I know what you're thinking. Cruise ships? Really? Hear me out. Stanley Druckenmiller, one of the greatest macro traders who ever lived, once said that buying airlines is really a macro bet on oil. Same logic applies to cruise lines. Maybe even more so, because fuel is one of the single biggest operating costs for these companies. So ask yourself, if oil prices fall meaningfully over the next few months, which sectors are not priced for that outcome yet? Cruise lines, full stop. Royal Caribbean is the best run operator in the space by a wide margin. Look at the most recent earnings. Royal's numbers blew away Norwegian, blew away Carnival. It's not close. When you're picking in a sector, you want the best horse, and Royal Caribbean is it. Here's the setup. The stock is sitting at $262 per share. All-time high was $362. That's a 28% discount from peak. Meanwhile, Delta Airlines, also an oil-sensitive play, is within 5% of its highs. The market has not rotated into cruise lines yet. That gap is the opportunity. Valuation. The stock trades at roughly 15 times this year's earnings and closer to 13 times next year's. That's below the S&P 500 multiple. You're getting a best-in-class operator at a discount to the broader market. That doesn't happen often. Now the risk, and I'll be straight with you. If oil stays elevated or goes higher, this thesis slows down significantly. The consumer staying soft is also a headwind. These are real risks. I'm not going to pretend they aren't. But here's my take. At $262, Royal Caribbean is a stock you will not regret owning 2 years from now. If oil comes down and the consumer strengthens, the stock is back at highs. If neither happens, you're still holding a cheap, well-run company with a growing order book. My preferred entry would be in the low 200s, but even here, the risk-reward is solid. Let's move from one of the most recognizable names in travel to a software company that almost nobody outside of Wall Street has heard of, but that is absolutely on fire right now. Zeta Global. If you've been watching this channel for any length of time, you know this is one of my highest conviction positions. If you're new, let me tell you why. Imagine you're walking through a diamond mine. There are massive clear diamonds sitting right there in the dirt, but there are also landmines everywhere. One wrong step and you're done. That's software right now. There are going to be enormous winners. There are going to be companies that go to zero. You cannot just buy a software ETF and call it a day. You have to pick the right ones. Zeta is one of the right ones. Here's what they do. Zeta is a data company first, marketing platform second. They have one of the largest consumer data sets in the country. We're talking billions of data points, and they help companies use that data to reach the right customers at the right time. AI is not a threat to Zeta. AI is rocket fuel for Zeta. The more sophisticated the targeting gets, the more valuable their data becomes. The numbers: 50% year-over-year revenue growth, 19 consecutive quarters of beating and raising guidance. 19. That's not luck. That's a machine. The company just crossed into net profitability for the first time, and they launched Athena in March, an AI layer that makes their platform dramatically easier for customers to use. Customers were already seeing 600% ROI on their Zeta spend. Athena pushes that number higher. The stock pulled back from about $20 after earnings to around $18. That's just the market digesting a big move. The trajectory is intact. Valuation, trading at roughly 12 times 2027 earnings, below the market multiple. For a company growing revenue at 50%, the risk? It's a small-cap software stock. It will be volatile. If macro conditions deteriorate sharply, growth multiples compress. I've sized this position knowing it could swing 30% in either direction in a short period. But the long-term picture? This is one of the cleanest stories in software. I'm not adding. I'm holding. And I'm happy holding. Drop a comment below. Are you in any software names right now? I'm curious what the community is watching. Let's shift from a company most people have never heard of to one everyone knows, but almost everyone is wrong about. UiPath, ticker Path, trading around $10 per share. The crowd hates this stock. Wall Street analysts have largely given up on it, and that is exactly why I'm interested. Let me give you the framework I use for software stocks in the AI era. I break them into 3 buckets. Bucket 1, companies with essentially zero risk of AI displacement. Cybersecurity firms. Data infrastructure plays like Zeta, Snowflake, Palantir. These are going to be winners because AI needs their products to function. Bucket 2, execution stories. Companies where the outcome depends on how well management navigates the transition. UiPath lives here. So does ServiceNow. So does Salesforce. Big difference in outcomes ahead. You need to pick the right ones. Bucket 3, the do not touch zone. Adobe, Duolingo, Workday, Monday.com. These are companies where AI could meaningfully disrupt the core product and the market could take 5 to 10 years to reprice that risk. You don't want to wait that long. UiPath is in bucket 2, but it's priced like it's in bucket 3. Here's what UiPath actually does. Robotic process automation. Think of factory robots that do the same physical task thousands of times per day with 0 errors. UiPath does that digitally. They automate repetitive enterprise workflows at massive scale. Now add AI agents. UiPath is building an orchestration layer. Governance, security, reliability, I'm for those agents. When agents make mistakes, UiPath is the oversight layer. When Walmart is running UiPath tens of thousands of times a day, they are not going to cancel that subscription and start experimenting with API calls to an LLM. The cost alone makes no sense. The security risk makes no sense. The numbers, no debt, $1.7 billion in cash, $500 million share buyback just announced, trading at approximately 9 times 2027 earnings, PEG ratio of 0.3. That is the lowest PEG ratio I can find anywhere in the stock market right now. The risk is real. Revenue growth has been slow. If they can't demonstrate 20 to 25% top-line growth, the multiple doesn't expand. That's the bear case. But at these prices, just getting back to a market multiple would be roughly a double from here. That's your downside if you're wrong. That's the upside if you're right. This is one of my largest holdings. Now let me show you a stock that's not about defense against AI disruption. It's actually the opposite. This company gets bigger every time an AI agent is deployed, Rubrik. Here's the easiest way to understand what they do. You ever play a video game and die right before a boss? You respawn at the last checkpoint. You don't restart the whole game. Rubrik is the checkpoint system for enterprise companies. They continuously back up operations. So if a cyber attack hits, the company doesn't lose days of data. They revert, they recover, they're back online fast. That is a mission-critical product. You don't cancel mission-critical products. But here's the twist that makes this story even better. The biggest bull case for Rubrik right now is AI agents. Think about it. AI agents are being deployed across enterprises at an accelerating pace. But agents aren't perfect. Success rates are roughly 80 to 90%. They make mistakes. They can be manipulated. They create new attack surfaces for bad actors. Every AI agent that gets deployed is an argument for buying more Rubrik. The SaaS disruption that everyone is worried about in software, that disruption grows Rubrik's addressable market. The stock is at $57 per share. Analysts have been raising price targets heading into earnings, which is almost always a leading indicator of a strong report. I think the stock is back in the mid-60s to low 70s on a good earnings reaction. My 12-month target, I think this crosses $100. The risk, they haven't reported yet. That's binary risk. If they miss, the stock could pull back hard. I'm comfortable with that given the long-term setup. But Rubrik is one of the clearest AI beneficiary stories I can find. Not a maybe, not a hope, a structural tailwind. If you're finding this breakdown valuable, smash that like button. It genuinely helps this channel reach more serious investors. Here's where it gets interesting. Let's leave the AI world entirely and talk about a high-risk, high-reward consumer play, one that is down over 85% from its all-time high. I want to be upfront about this one. This is the highest risk play on the list. Sweet Green. The stock is at $6.68. All-time high was $56. You're looking at an 88% drawdown. But here's what I see. Sweet Green is operationally similar to Chipotle in the early years. Fast casual, quality ingredients, loyal urban customer base, strong brand identity. And just like Chipotle saw same-store sales decline during consumer weakness, Sweet Green is experiencing the same thing right now. Here's the thesis. Oil comes down, real wages rise, consumer spending picks back up. The same tailwind that lifted Chipotle out of its soft patch hits Sweet Green. The difference is Chipotle was already large and had proven unit economics. Sweet Green is still scaling, which means the upside from a same-store sales recovery is proportionally larger. The numbers. Nearly 1,000 locations. Market cap around $800 million. Revenue this year approaching $900 million to $1 billion. If they execute and same-store sales inflect positive, this thing re-rates dramatically. The risk is obvious. If the consumer doesn't recover, if oil stays high, if execution slips further, this stock has more downside. This is a company that is not yet profitable. That makes it sensitive to sentiment swings. At $6.68, I think the bad news is priced in. I think the risk-reward skews positive for anyone with a genuine high-risk tolerance and a 2 to 3 year horizon. Speaking of consumer-driven upside, our next stock is another one that's been crushed and has a very specific catalyst that most people are overlooking. ELF Beauty, ticker ELF. Stock is around $60 per share. All-time high was $221. That's a 73% haircut. Here's the thing about ELF. Go ask any young woman, teenager, college student, young professional, what makeup brand she buys. I will bet you hear ELF more than any other brand in the affordable category. That brand loyalty is real. That's not something you manufacture with advertising spend. It's earned. ELF has built a product line that competes with brands costing 5 to 10 times as much. In a consumer environment where people are watching their spending, that positioning is powerful. When the consumer gets stronger, they still keep buying ELF because they love it, and they may trade up within the ALF line. The company has been navigating a rough macro patch, same as most consumer discretionary names, but the core business, product quality, brand strength, distribution, has not deteriorated. At $60, you're buying a brand that was valued at $221 not long ago with roughly the same long-term earnings power. That kind of discount doesn't last forever. The risk, sentiment around consumer discretionary stays soft if macro conditions don't improve. That's the main headwind. I'm watching this one closely as oil comes down. Now let's talk about the most controversial stock on this list, one that I know is going to generate comments. Tesla. Yes, Tesla. It's on the list. Look, Tesla accounts for roughly 20% of the consumer cyclicals index weighting. So when cyclicals move, and I believe they're about to, Tesla moves with them, often harder than the sector itself. But the story is bigger than the index weight. I know there's a lot of noise around Tesla right now. Brand perception, political baggage, whatever. I'm not interested in the noise. I'm interested in the assets. Tesla is not an automaker. Tesla is a vertically integrated AI and robotics company that happens to sell cars to fund everything else. Robo-taxi network, semi-truck fleet, Tesla Bot, a proprietary compute infrastructure for training autonomous driving models. These are not press release promises. These are products in active development with real revenue timelines. The stock trades with consumer cyclical sentiment in the short term. That means it gets hit when consumer confidence falls and oil rises. And that means when oil falls, Tesla tends to outperform the sector on the way back up. I own Tesla. I plan to own it for the next 3 to 5 years minimum. Short-term price movements don't concern me. The risk. The core auto business faces real competition globally, especially from Chinese manufacturers. Execution risk on robotics and robo-taxi is real. These timelines have slipped before. But long-term, if even one of those moonshot businesses hits, robo-taxi alone at scale, the current market cap looks like a bargain. Share this video with someone who needs to hear a different take on the market right now. Most people are only getting the narrative from mainstream financial media. Our next two picks share a similar theme. Massive drawdowns, iconic brands, and a very specific macro catalyst, Lululemon. From 516 in late 2023 to 129 today. That is a stock back at 2018 price levels. I want to be transparent. I don't own Lululemon. This is not one of my highest conviction picks. But the setup is hard to ignore. Lululemon's core customer is aspirational, upper middle income, health-focused, brand loyal. That customer has been tightening the belt. Not because they can't afford it, but because sentiment has been negative and cost of living pressures are real. When oil comes down, when mortgage rates ease, when the wealth effect from a stabilizing housing market kicks back in, that customer starts spending again. Lululemon is positioned to capture that spend. No debt on the balance sheet. Strong global brand. Expanding international presence. The fundamentals haven't broken down, just the sentiment. The risk, competition in premium athletic wear has intensified dramatically. The brand may not recover its growth multiple even when the macro environment improves. That's the real question here. At $120 after a nearly $400 decline, I think the market is priced in too much pessimism, worth watching closely. Same thesis, even more extreme drawdown. Next up, a name that used to be synonymous with American sports culture, Nike, around $43 per share. That's a price level you haven't seen since 2014. Think about that. Everything that Nike has built, launched, and grown over the last decade, all of it is essentially unpriced into the stock right now. I don't own Nike, but I'm paying very close attention. Here's a signal I don't take lightly. Tim Cook, Apple's CEO, one of the most respected allocators in corporate America, is putting millions of dollars into Nike. When someone of that caliber buys at these levels, it's worth asking what they see that the market doesn't. Nike is navigating a real transition. They over-indexed on direct-to-consumer, pulled back from wholesale too aggressively, and are now rebuilding those relationships. Leadership changes were overdue. They've been made. The reset is underway. The risk, execution. Nike has to execute a turnaround while competing with Adidas, On, Hoka, New Balance, all of which have taken meaningful market share. That's real competitive pressure. But at $43 with a brand that still commands global loyalty across sports, culture, and fashion, this stock at 2014 prices is starting to look very hard to ignore. All right, we've covered consumer plays, software, and cruise lines. Let's close out with the most under-the-radar AI infrastructure name I can find right now. This might be the one that surprises you most. Core Scientific, ticker CORS, around $22 per share. This one takes some explanation, so stay with me. Core Scientific started as a Bitcoin mining operation. Most crypto infrastructure companies stayed in crypto. Core Scientific pivoted hard into high-performance computing and AI data center infrastructure. And that pivot is happening at exactly the right moment. Here's the analogy that makes this click. Imagine Miami issues 100 liquor licenses. The city is growing, demand is exploding, and suddenly there are 200 restaurants competing for those 100 licenses. The value of each license goes up dramatically. You can't create a new one. You have to buy one from someone who already has it. Core Scientific has the licenses, the permits, the physical infrastructure, the land. In an environment where states are actively blocking new data center development in certain areas, companies with existing operational capacity become extremely valuable. CoreWeave, a company that knows this space better than almost anyone, attempted to acquire Core Scientific at a valuation of $9 billion. Shareholders rejected it. The current market cap is around $5.6 billion. That gap tells you something. The numbers. Management is projecting roughly 80% revenue growth for multiple years into the future. 13F filings from smart institutional money have been bullish, and the stock has done very little since late 2024. Which I read as an opportunity, not a warning sign. The risk. This is a semiconductor-adjacent, high-performance compute story. Volatility will be significant. If the data center build-out slows, the multiple compresses. If Bitcoin drops sharply, sentiment around anything crypto-adjacent suffers even if the fundamentals are decoupled. But if you believe AI data center demand is structural, and I do, then Core Scientific at $22 with 80% projected revenue growth is one of the better risk rewards I can find in this space right now. Let me bring it all together. If I had to rank these 10 by conviction, not necessarily upside, but by how confident I am in the thesis, here's where I land. Tier 1, highest conviction, positions I currently own. Zeta Global, UiPath, Tesla. These are positions I hold with a multi-year time horizon. I'm not trading around them. I'm holding through volatility. Tier 2, strong setups watching closely. Rubrik, Core Scientific, Royal Caribbean. These have clear near-term catalysts. Rubrik on earnings. Core Scientific as AI data center demand becomes undeniable. Royal on oil. Tier 3, macro-dependent plays. Sweetgreen, ELF, Lululemon, Nike. These work beautifully if the consumer recovery thesis plays out. If it doesn't, they're slower. But at current prices, I think the downside is more limited than the market implies. Here's the thing I want you to take away from this video. The market rewards patience and punishes impatience. Every single stock on this list has been punished, some of them severely, for reasons that are mostly temporary. Macro conditions, sentiment shifts, sector rotation. The crowd is not in these names right now. The crowd is in what worked over the last 12 months. And the crowd is usually wrong at the exact moment it matters most. Real wealth is built by buying what's overlooked, understanding why it's overlooked, and having the conviction to hold when it's uncomfortable. These are stocks I believe in. Not blindly. I've shown you the risks on every single one. But I believe the upside cases are more likely than the market is currently pricing. Before you click away, 3 things. 1. If you got value from this breakdown, hit that like button. It takes 2 seconds, and it genuinely helps this content reach more serious investors like you. 2. Subscribe if you haven't. New analysis every week. If you want to stay ahead of the market, this is where you want to be. 3. Drop a comment. Tell me which of these 10 you find most interesting. I read every single comment and I build future content around what this community actually wants to learn. And one last thing, the most important thing, I am not a financial advisor. I am not your financial advisor. Do your own research. Come to your own conclusions. You could lose money on any of these names. The world is uncertain and markets are unpredictable. What I've given you today is my honest analysis. What you do with it is entirely up to you. I'll see you in the next one.